With us here on 3 Business, going to be analyzing the impact of this latest inflation figures as we go on our subsequent bulletins. But the cedi has remained largely stable since the Monetary Policy Committee of the Bank of Ghana implemented measures to arrest the falling cedi and rising inflation. While inflation remains high, as we've seen now, the cedi has remained largely stable over the period after some initial gain. But it appears that these same measures have constrained banks from investing heavily in Treasury bills, contributing partly to the low patronage. And Akia Mensa Brampa, my colleague on the business desk, has more.
In March this year, the Monetary Policy Committee of the Bank of Ghana announced some far-reaching measures to arrest the falling cedi and rising inflation. Besides increasing the policy rate by 2.5 percentage points, 17%, it also increased both the primary reserve and capital adequacy ratio for banks. Market watchers say the directive compelled banks to slow down on the buying of foreign currency and rather quickly change their forex into cedis to meet the new requirements. Now, the situation significantly increased demand for the cedi, and conversely, the demand for the dollar dropped, and this played a role to stabilize the cedi. However, the same policy that helps stabilize the cedi is hurting demand for government treasury bills and bonds. Banks are known, in fact, criticized for investing heavily in treasury bills at the expense of lending to the private sector. But with pressure on them to maintain a higher primary reserve, the banks no longer have the laxity to patronize the treasury bills, and Professor of Finance John Gachi believes this partly accounts for the undersubscription of government securities.
The new monetary policy measures that have been taken by the Bank of Ghana meant that they have increased the cash reserve by about 3 percentage points. What that means is that you have largely reduced the liquidity position of the financial institutions, especially the commercial banks, and their allocation to such investment has been questioned already in a credit rating of some of the few banks, and that gives signal to the rest of the banks. And again, the liquidity position of the banks to buy into those instruments has also reduced by the increase in the cash reserve.
As the Monetary Policy Committee plans to meet next week, this fallout of their previous decision may engage their attention in deciding on what new monetary measures should be taken, if any.